Good afternoon, ladies and gentlemen, members of the board. I'd like to thank you for retaining us today as consultants to help you deal with the two crisis situations that are currently facing your company. In our previous engagement with you, we developed a new competitive strategy for Draxis based on what we saw as the three key issues facing your company. Number one, how do we create the most shareholder value? Number two, what is the source of your company's future growth? And number three, how do we mitigate risk as much as possible? In our evaluation today of the new foreign currency exposure that you just signed up to and the proposed takeover, we will attempt to address those problems with these three key issues once more. I'll now turn it over to Patrick to address the takeover scenario.
So currently you have a takeover offer from a venture capital company. We think this is a private equity company. This is probably a bit of a concern. We recommend that you reject the offer immediately or advise your existing shareholders not to tender their shares. Private equity isn't what it was in July. We don't think even a significant offer of a 50% premium from private equity is going to offer you the value that we see in your company through our existing platform for where we think your company should go. And as a result, we think it's best to continue to look for other alternatives. Now, why? We see our go-forward plan for the company creating far more value for your company and your existing shareholders than existing private equity of 50% premium could give you. And we see that value far greater than that premium. We also think that your institutional support, the institutional shareholders, will probably reject any offer. And we also couldn't find any solid metrics to value this on. So we think it's kind of tough to say right now what comparable analysis we should use. Coming to that, we have run a comparable analysis of a number of companies in the similar space. None of them were an exact size, none of them were in an exact market, and none of them were in the same area of their product life cycle as Draxis was. All of this results in a variance in the multiples that is huge, and we think it's tough to value the company based strictly upon comparables. Okay, and based on that, we also have not seen any recent private equity transactions that were of a small to medium-sized manufacturing pharmaceutical company or radio pharmaceutical company. So we don't see any recent transactions. Similarly, we took a look at the weighted volume average price of your existing shareholders. The last turn of the float, your current share price of $3.86, 96% of those shareholders in the last turn are out of the money. It's going to be tough to convince shareholders that they should accept an offer right now and crystallize that loss when there's so much future growth potential for this company. So as I said, current share price at $3.86, 95% of the shareholders are out of the money. And we don't think the institutional shareholders are going to want to crystallize a loss at this point in time. So now I'm going to pass it off to Arif Malji, who will explain to you the vision for your company that we've explained earlier this morning and show you why we want you to reject any offers.
Thanks, Patrick. That's exactly where we're at. We're talking about the value proposition that we're putting forward for the company, what the recommendations were, and how we're going to add value to the shareholders. If we can just step aside for a moment, it's important for us to point out again what the key issues for the company were moving forward and why we've made the recommendations we did for the value proposition to the shareholders. Those being risk mitigation, the need for growth to provide long-term viability and profitability for the company, and shareholder value. Draxis Pharma has two subsidiary business units, one being Draxis Pharma in the contract manufacturing business. And again, in keeping with the need to be prudent for the risks upcoming, the contract manufacturing industry in the next 3 to 5 years or potentially longer, there is the possibility for offshoring. There is possibility for outsourcing. There are risks associated with any immediate expansion in contract manufacturing. For this reason, we've put forward to the company that it's a hang on to the home base. There's no need for immediate expansion, a conservative approach that focuses upon as the demand comes, look at expansion at that point. In line with this, the contract manufacturing business does have stable cash flows, The cash flows are relatively fixed because of the high switching costs associated, as well as high barriers to entry in a highly regulated market space. In addition to that, we clearly recommended that this market space for Draxis was changing, and was changing relatively rapidly. The radiopharmaceutical side of the business was going to be the key driver for future growth. And in keeping with this, we put forward a recommendation that looked at how do we grow this business safely, i.e. mitigating risks, providing long-term growth and profitability, and providing value to the shareholders. Our recommendation is a distribution agreement with a global pharmaceutical player. Why do this? They have global expertise, they have global brand recognition, they have access to global markets, and in having the expertise with respect to regulatory bodies, policymakers, lobby groups, and pricing teams, this would help to mitigate the risk of a small Canadian company trying to enter global market spaces on their own. We even took this a little bit further, and specifically through our analysis made a recommendation of who this player would be. That is Bristol Myers Squibb. Why Bristol Myers Squibb? This deal reeks of synergy. But let's take a step back and say, would Bristol Myers Squibb actually consider Draxis as a partner in a distribution agreement? And the answer is absolutely. 6 years ago, Bristol Myers Squibb set precedent in its agreement with ImClone. ImClone, at that time a smaller company, somewhat like Draxis is today, had a high level of innovation, high level of intellectual property, and Bristol Myers Squibb saw value in their in a need to fill their deteriorating pipeline with the addition of Erbitux, a cancer treatment. In addition, we talked about the global presence, the capability for global expansion. Bristol Myers Squibb offers this to Draxis in their radiopharmaceutical business. As we know, Draximage, the Draximage sub-business unit, has 2 new products coming. A generic version of Bristol Myers Squibb's CardioLite for imaging coronary artery disease or myocardial perfusion, as well as a technetium-99 generator. Now we talk about the synergies. Let's just take a step aside here and talk about these therapeutic areas. Bristol Myers Squibb is dedicated to cancer therapy, and Bristol Myers Squibb's portfolio is largely made up of cardiovascular drugs. In both arenas, there's a need for first diagnosis and then treatment. What does Draxis do, or Draximage? Diagnosis. We can provide them with the opportunity to diagnose cancer, and they can treat it. It's a fit. We can offer them the opportunity to diagnose coronary artery disease and then treat it. And treat it with what? Plavix, the world's 4th largest manufactured drug. This is a huge opportunity for Bristol Myers Squibb, and the value proposition that this puts forward to our shareholders is immense. And at this point, I'm going to pass it off to David, who's going to talk about what that financial value proposition is.
So what we did, come up with an incremental value for the Sestamib drug, or the Sestamib diagnosis indicator, and the technetium-99 generator that Draxis is currently developing, is we took their management estimates of the current market that's available in the United States. They had $500 million estimated market for the Sestamib indicator and $150 million for the technetium-99 generator. We then ran, based on what we assumed would be the market percentage they would be able to capture, a rudimentary discounted cash flow or net present value analysis on this. This scenario also is based on a 50-50 revenue split with Bristol Myers, assuming that distribution agreement that Arif spoke to happens. So we come to a per share value here of $3.13 based on our analysis. And then we said, well, what happens if Bristol Myers doesn't go for a 50-50 split? So we developed a sensitivity table here, just showing various revenue shares and various market capture percentages down the vertical axis here, just so you can see what the value is at various deals. So then this brings us back to the takeover. We can see there is value here in Draxis's new products. And as Patrick alluded to earlier, the value that a private equity firm is going to be giving you in a premium to share price will probably not equate to this $3.13, which is approximately 80% or somewhere in that order. So there are several takeover defenses that we can consider. They're listed here. The recommendation that we, however, give is to use a combination of them. First of all, you should lobby your institutions, the institutional shareholders that have been supporting you all along. And as management alluded to in their presentation, they do have a strong base. With the previous third quarter results, they were negative results. The share price dropped, but the share price only dropped on 2 million shares out of the 42 million outstanding. So there are some key holders that have been holding for a long time. Number two is we think you should get an objective opinion. So hire a third-party investment bank to value the company just in case there's something you're missing, and possibly shop the deal around to look for other suitors. And then number three is, if it comes down to it, look for a white knight to help you possibly realize more value for your shareholders. In this case, that would be Bristol Myers. If you have the existing relationship with them, as you already do in Canada, and possibly another deal, they're going to have more insight into your company, more inside information, so they'll be able to more accurately value your future prospects than anybody coming from the outside without that information. So that's our recommendation on the takeover. I will now pass it over to David, who will address the foreign currency exposure.
Thanks, David. So aside from an issue with a potential takeover, we also have a bit of a problem when it comes to a new contract that just came in. We have a $120 million contract denominated in US dollars. And how is it generated? Well, it's generated by sales that, however, are costing in Canadian dollars. So we have a bit of a potential for mismatch of currencies, and we need to address that. Now, but let's think about it. Should we actually address it? After all, it's a risk that, that's diversifiable, and shareholders can diversify on their own. But can they diversify as efficiently as the company itself? And this is a very key point at this moment, because your company actually knows exactly the detailed cash flows that it anticipates. It's a detailed information that's not disclosed in detail. So the exact matching and the efficient hedging strategy is really best suited to be handled by the company on behalf of its shareholders. There's a couple other issues to address as to, well, it's a 20-year-long contract. How should it be hedged if the company does it on behalf of shareholders? Well, we will guide you through several alternatives. And they are alternatives ranging from just straight fixed forwards to various options. We did explore a few exotic options, but the complexity, given the level of the sales, doesn't seem to be suitable. And as a result, we explored the potential for using plain vanilla options. This alternative could be effective in a short run because the premium cost is not excessive given the time value of the option. But it does become ineffective in a long run. So we also pursue the search for zero-cost structures. I mean, at a certain point, your company won't be interested in paying enormous amounts of premium to be hedging a contract because you may be destroying shareholder value. In fact, you may be destroying shareholder value by potentially overhedging. You also don't want to overhedge 100% of your revenue. That if there is a potential uncertainty, it's a 20-year-long contract, it could leave you in a speculative position without the underlying instrument. And so some of the zero-cost structures do have limited downside. However, they also limit your upside. There is a trade-off that every customer, every company out there has to decide on how to handle. What is the priority? Foreign exchange market has been volatile over the last year, and it has been volatile historically. And so after analyzing various zero-cost structures, such as forward extras, participating forwards, which further can have potential liabilities carrying along them, we came to a conclusion that we really should use derivative products on short-term basis only. We should use them based on the percentage of sales. And so we should, on annual basis, within the years 2009 to about 2015, we should be leaving certain percentage unhedged, which will be increasing over the course of the time because, of course, furthermore down the line, there is a greater uncertainty about revenues coming in. For a very short-term annual hedging, we recommend using fixed forwards. We'll actually guide you through the timeline as to how to structure this hedging strategy. And then we recommend furthermore to be using options. We prefer towards the later part of the short-term horizon to be using zero-cost structures because premium costs become prohibitive. And last but not least, we need to consider hedge accounting implications. This is something that your company is not used to doing at the moment. You guys don't have a hedging practice, hedging policy, and it does carry along impact that will flow through your financial statements. And so after addressing the short-term hedging, we also looked at what are we going to do with this fixed currency contract from years 2015 onwards to 2029. And we thought about it for a bit and thought, well, there are alternative derivative contracts that are not prohibitively expensive, such as cross-currency swaps, but the downside to those is that there is an unlimited loss potential. As a result, we analyze what our underlying strategy is. We do have potential expansion growth planned in our plan, as Arif already mentioned. And so we decided that a natural hedge would be the best possibility for the company. As a result, we are suggesting that a US dollar cost-based operations that would generate Canadian dollar flows would be a perfect offset to a scenario, to the risk that you are facing with the new contract. And Arif will now guide you through the detailed structure.
We'll just take a step aside here for a moment again, and I'll apologize on the behalf of my colleagues. But it's again important, it's imperative to point out the key issues facing the company. Long-term shareholder value, growth producing long-term viability for the company, and risk mitigation. We talked about the value proposition that we've put forward for Draxus and the shareholders by way of the distribution agreement with Bristol Myers Squibb. The bottom line financial benefit to the shareholders is $3.13 realized on the share price of incremental value. We don't believe that any takeover bid, regardless of how high the premium is, unless they're willing to offer about 100% premium, comes close to that opportunity. So we're taking care of our shareholders through our recommendations of risk mitigation and growing the company and providing shareholder value. We talked about the anti-takeover bids with respect to the white knight opportunities, poison pills, and golden parachutes. David lastly talked about the hedging strategy with respect to the exposure to the U.S. currency. In the short term, that's fixed forwards in the horizon of 1 year. Moving forward out to 2 to 3 years, and I guess the short to medium term, we looked at plain vanilla options, such that the cost of the options was less than 2% of annual revenues. Going out to about 5 or 6 years, there was a need to move to zero-cost structures, like collar options, that limit the up and downside potential of these structures. In the long term, David mentioned the need to put forth a natural hedging strategy. This was accomplished by the acquisition of an asset that generated Canadian dollar revenues on the US-based cost structure. So again, we'd like to put forward to you the proposition that this recommendation focuses upon the key issues facing the corporation today, moving forward for their long-term growth strategies. Again, I hate to say it, but it's imperative to put it forward. There's a need to mitigate risks. There's a need to show shareholders value and long-term profitability for the corporation. Thank you very much, and we're available for questions.
I'm a little confused on your private equity response. Are we going in the trenches and fighting here? What are we supposed to do?
I think the key with the private equity deal is, prior to July, and primarily the early August when the asset-backed security markets and debt markets really hit the turbulence they're in right now, you may have seen a 50% premium on your share price. You may have seen a 70% premium, but we don't think you would have seen any more. We see, a 50% premium on your $3.86 stock right now being about $1.90 a share, bumping you up to, $5.70. We think our value just in the radiopharmaceuticals gets you to a $7 share price, not including any incremental growth in your other business units. Therefore, unless private equity can offer you at least 100% premium on your existing share price, there's probably little value in accepting the private equity deal. And then therefore, you do want to go to the trenches. You do want to dig your heels in, get your institutional investors behind you, and let's fight. Let's try and avoid any takeovers we can, and let's grow this company, or Draxis should grow the company as they can. And
I was just confused because I heard another point about looking for a white knight or something like that. Is that?
That was a reference to a last resort, if it came down to that.
Oh, okay.
Yeah.
I understand. Why wouldn't we just go and try and sell this to Bristol-Myers?
Again, I don't want to take two questions in a row, but I will. We initially, when we were looking at our previous recommendations, we thought maybe we'll sell contract manufacturing. That's 75% of today's revenues. We looked at selling your radiopharmaceuticals to Bristol-Myers Squibb, but that's your upside potential. Neither side really did a whole lot for existing shareholders. Keeping them together did a lot. Now, from Bristol-Myers Squibb viewpoint, chances are they don't want the contract manufacturing side. They're interested in the radiopharmaceuticals. They have a use for it. But do they have an interest in doing contract manufacturing on a $120 million contract for Johnson & Johnson? Probably not. It's not really what they're in the business of doing right now, and we don't think that's a fit for them. We think a joint venture works best for both companies.
And did you take the opportunity to try to reverse engineer what the private equity firm might be looking at, and maybe they're prepared to pay you for the present value of the Bristol-Myers? Did you do any reverse engineering to come up with what potential price they might be prepared to pay?
That's what Patrick was trying to get to with his comparative analysis, but with insufficient comparable M&A transactions in this space, and with it very difficult to find a proper comparative set for a company like Draxis, it was difficult to come up with proper metrics for a private equity deal. So if they had the information that Draxis and its partners had, they very well may be able to come up with the valuation we did, or maybe even higher. They might realize more value. And in that case, we are not recommending that they fight this, but we're saying it's unlikely that they have that information and would be able to see that value.
Yeah, the analysis I saw was a comp analysis. That was good.
Yeah.
That was very helpful. It was the reverse engineering of what their model looked like. I'm assuming you just didn't get the opportunity to do it.
No.
So your recommendation is to tell the private equity firm to go away and you're going to look for a partnership. What is plan B if that partnership is not possible?
We definitely expected that to be a possibility. We looked at other, the key was, if we look at it from a general perspective, is looking for a partner that provides the global expertise that Draxis needs for its innovative products to have expansion. As well as that, there was a need for synergy in the therapeutic areas that Bristol-Myers Squibb has expertise. So to point out a couple of other alternatives, Eli Lilly has competitive products in the cardiovascular arena, as well as cancer treatment, as does AstraZeneca. Those would be other routes to look at as well.
I am, though, a bit puzzled as to why you select Bristol-Myers Squibb. They have a sestamibi technetium that's going to be coming off patent. They will continue to manufacture it. They don't need us unless our cost base is less. So what is the cost of manufacturing a mold of technetium by Draxis versus the cost that Bristol-Myers Squibb has of manufacturing a mold of technetium? Unless the cost is different, I can't see why they would be interested in such an arrangement. It would be like Apotex going to Merck and saying, well, your simvastatin's off patent, we have a generic simvastatin, we'll co-license. What's the advantage to Bristol-Myers in a situation where they can continue to manufacture in much higher volume an isotope?
Absolutely a fair question. Our perspective on the distribution with Bristol-Myers Squibb was with the genericization of Cardiolite.
But would they have the product? They will continue to make the product.
Yes.
So why would our generic be cheaper to manufacture than theirs? Is it?
Presumably because of the lack of the need for the R&D expenditure up front.
But that's all been spent. They have a product, they've been manufacturing the product for the life of the patent.
Yeah.
So what's the pitch? How are you going to sell it to them?
I guess how, just
Sure.
if you don't mind, how we looked at it is right now they know there's generics coming to the market. They're going to have to lower their pricing on their existing drugs. They own the generic, and probably the only generic coming to market at this time frame. They don't have to lower their price on their existing drugs. So they retain margin that otherwise would be dropped. You know, right now the market is about 500 million. With the generic entering, they're looking at about a $250 million market. If they own both the generic and their existing drug, maybe that market drops to a 375, maybe it's 400, but they have more pricing control and can take a bigger piece of the pie that way.
Now, don't you think that would lead to some form of regulatory scrutiny?
Quite possibly.
And would that not pose an additional set of risks?
There's still competitors in the space, though.
Who else is coming to market with the generic system, maybe?
There's no one that we know that's coming currently with a generic, but MyoView does have another year in its patent life. So they would still be in the market space.
Mm-hmm. And my understanding is that technetium is made by bombarding molybdenum with neutrons. What might we anticipate in commodities risks in terms of the price of molybdenum as the basic product for our generator for creating technetium?
Address that. Okay. Well, just like all other commodity prices, molybdenum has been increasing lately. So if we're going to start developing products that include that, we should look to hedge our exposure to that commodity as well.
Was that in your modeling where you talked about the $150 million technetium generator?
It was not in that model, but we made rather conservative assumptions about the market share that they would take to account for unforeseen things such as that.
On the currency recommendation, I get the short term. The long term again was to move plants. Is that, or did I miss that?
No, it is a part of the natural progression of the growth strategy for your company. It's essentially is an idea of swapping and reversing the cash flow structure. Right now you have Canadian dollar cost-based facility that's exposed to that's generating US dollar revenues. We are potentially part of the strategy, and part of the opportunity for a company is to explore currently, given the currency exposure, cheaper facilities in the United States. If there is a potential to produce drugs that can be sold in Canada, you're essentially reversing the cash flow and swapping them, matching US dollar cost with US dollar revenues generated from a different subsidiary and vice versa.
So I'm to open a plant in the United States?
Right.
Any problem getting, I just moved the contract manufacturing there, or both businesses?
No, go ahead.
I think what we were looking for there was to purchase a facility as a natural progression in our contract manufacturing as that business segment grows. And with the strength of the current dollar, let's buy a U.S. facility and establish operations there. And then that's probably the cheapest place to expand right now, to be honest with it, where the dollar is right now. So.
Is there any circumstance under which you would entertain the bid from the private equity firm?
Yeah, for sure. If their valuation was somewhere close to the valuation that we arrived at for the upside of the radiopharmaceutical potential, then, I mean, if that was there and the value went higher than our shareholders were, or they were willing to accept it, then I don't see why you wouldn't accept it.
There's going to be a lot of pressure. Oh, sorry, go
So I
ahead.
was going to say, well, is there a process then for us to fish that out of them? How do we know what they're going to pay us? Is there a process we should go through? I mean, I heard you say fight. Can I fight and love at the same time? I mean,
Well, that's what we were trying to, I guess, get to with the shopping around with the investment bank and stuff like that. I mean, they're going to come with an offer. You're going to know what they're offering then. If you're happy with that and it meets what you value the company at, then that's it, right? But if you take it the next step farther and you're not happy with their offer, then you go looking for other suitors or other offers to possibly value you higher.
okay, then I'm confused. Am I starting a process or not?
You're trying to avoid the process, but if the ball's rolling on it and there's no stopping it, if you get to a point where that private equity is coming and it's a hostile takeover and you have no choice, you bring in your investment bankers, you try and find, I guess, essentially the white knight at some point that is a company that you have synergies with and that you can work with, because private equity may come in and carve up this business, separate the contract manufacturing from the radiopharmaceuticals and derive value that way for themselves. Whereas I think Draxis just wants to continue as a whole, and I think that's best for them and for their existing shareholders right now.
There'll be a lot of pressure for the institutional shareholders, for all shareholders who look for us to try and create value as quickly as possible. And while I appreciate the work you've done that would say that we, in the long term, can create this value, how are we going to deal with the time frame issues on the, we're going to be able to we'll have to lock something up pretty quickly to demonstrate to institutions that that value can be created and that risk of not having global distribution can actually be addressed. So how are we going to deal with this from a timing point of view?
Essentially, the idea is that we are going to start exploring and announce the search for a strategic alliance for a global partner in terms of distribution agreement. And once that partner is found and the agreement is reached, the company can make an announcement which can then be valued by the market. And this is where our analysis came in and projected the share price appreciation.
Now, that's something we've noted in a number of our things that we've released to the market, that we are expanding into Europe and that we're going to look for distribution partners. And so we've been telling the market that for a couple of years now. And so the time frame, to try and do it under pressure is going to be difficult. Because I'm assuming, we've already been talking to people during this period.
And that's why we're pinpointing an exact partner that we believe is the perfect suit for you. And given the synergies created by the partnership, it will accelerate the process.
Additionally to those comments, if we look back a few years to when Draxis Health announced its distribution agreement with Bristol Myers Squibb in Canada, the response by the market was a share price increase of about 15% in the first 2 days, the day prior to the announcement and then the day following. And the volume of shares traded also rose exponentially.